Well, good afternoon, everyone. My name is LaTonda James. I'm with Miami-Dade Economic Advocacy Trust, or MDEAT, as we like to say. I want to thank everyone for joining us this afternoon on this webinar. This is the first of many that we will be doing, hopefully. And we have some scheduled for the next few weeks. So hopefully you'll be able to join us again. I want to say thank you to our featured guests today who are going to share a lot of valuable information for everyone. Just a little bit about our organization, Miami-Dade Economic Advocacy Trust. We are a Miami-Dade County entity. We were created 40 years ago as a result of the McDuffie civil unrest. So our organization is tasked with addressing the issues of Black parity here in Miami-Dade County. We have 3 departments at our organization: youth development, where we have our teen court program; economic development, where we work with small businesses to increase capacity and also by providing funding through our small business capitalization program; and our Homeownership Assistance Program, where we provide down payment assistance for first-time home buyers. We understand that becoming a first-time home buyer is challenging. A lot of questions are asked. A lot of people don't know where to start, don't know who to contact. And so we are thankful that people do contact our organization, but there are so many people out here who partner with us and they provide valuable strategies and information to assist you from class, like we like to say, from class to closing. So we want to ensure that we provide information not only about our down payment assistance products, but about everything that one would need in order to get them to becoming a first-time home buyer. So please make sure that you follow us on your social media sites. We're on Facebook, Instagram. I'm not sure about, I know Facebook and Instagram. So make sure you follow us. MDEAT Info is the handle, and you can learn additional information about other services and opportunities that we will have. So today we're going to be talking mainly about credit and how credit impacts your ability to obtain a mortgage. A lot of people have questions about credit. So we have some credit and mortgage gurus on the line. So I know that we're going to be starting first with Mr. Andre Coakley with Credit 360, and he'll spend about 15 minutes with us. And we have Fabiola. Thank you, Fabiola. She's with Blueprint Marketing, and she is actually administering the webinar itself. And so she will be fielding questions and things of that nature. So I'm going to turn it over to Andre, and he will start us off with our credit knowledge and information and helping us become better credit-worthy individuals. Thank you, Andre.
Before Andre starts, I just want to do some quick housekeeping. So if you do have questions while Andre and the other guests are speaking, there's a chat button that you can just drop your questions in there, and we'll just go through them periodically. Or as they're speaking, there's a hand raise button hit that we can also, if there was something that you need clarity on, just hit the hand raising button. Andre, it's yours, and I have your presentation on.
Okay. All right. So how you guys doing? Andre Coakley here, president of Credit 360, and I just welcome you guys who are taking the first steps to embark on home ownership. I know sometimes it can be very daunting, very challenging. However, I just welcome you guys to the experience, and I let you know that most people who have become homeowners in life, they've taken some major sacrifice. All right, so mainly what we're probably going to talk today a lot about those sacrifices that need to be accomplished in order for home ownership. Just to let you know, we're a local credit repair company down here in Miami, Florida. This is my team. However, I've also written a book, An Attempt to Repair America's Broken Credit System. You can find it on Amazon. It's been a #1 top seller. And if you need some additional information, I welcome you to grab this book off of Amazon. It has a lot of information where you can help dispute your own credit report and not necessarily need a professional like myself. All right. And if you can flip, Ms. Fabiola, thank you. So the first thing we want to break down is the actual credit score grading scale, right? So we need to understand, before you understand exactly the credit system itself, you need to understand what the grading scale is. When my kids start school every year, one of the first things I ask them is, well, what's the grading scale? And they look at me crazy. The reason why I ask them what the grading scale is because if you don't know the grading scale, I can't expect you to hit the target. All right. So the main thing we want you to do is understanding where you need to sit in order to qualify for housing. Most lenders in today's time during the pandemic, which we have Mr. Marc Williams on, he'll give you a little bit more details on that. However, most lenders are most likely requiring at least for you to have a 660 credit score or somewhere in that ballpark. All right. There might be some platforms that allow credit scores that are lower. However, it's most likely going to be affected and built into your rate. So the first thing I want to just talk about is a lot of times we think the higher your credit score, the more room you have to make mistakes, but it's directly the opposite. Like in this first example here, 5 top factors that hurt your credit. A foreclosure for someone who has bad credit, they would possibly lose anywhere from 85 to 105 points. Versus someone with good credit will lose anywhere from 140 to 160 points. A lot of people are like, well, wow, why would a person with good credit lose more points than someone with bad credit? For the simple fact that that person who has good credit has shown the capabilities of having the right characteristics of having a good credit score. So the expectation level is higher for that person than it is with someone who doesn't have that high credit score. For example, I have a son, he has a D average in school, and I have a daughter who has an A average in school. My son gets into a fight. I'm like, son, what you doing? Why'd you get into a fight? However, when my daughter gets into a fight with an A average, I'm crushed. Baby girl, why you got an A? You got an A average. You're way better than that. So the expectation level is higher for people who have higher GPAs the same way from a credit standpoint, all right? So just want to let you know that the higher your credit score is, the more detailed you have to be and more in tune you have to be. You can go to the next slide. Thank you. All right, so what we're going to do now is we're going to break down the actual credit pie chart, right? So we're going to break down what point usage and what actually contributes to your credit score. The main point or the largest point of contact with your credit score is payment history, okay? Payment history equates for 193 points of your credit score, or 35% of your credit score. So we have a lot of clients who come up to us and like, well, Andre, my credit scores are in the D category. They're very low. However, I never miss a payment. Missing payment only equates to 1/3 of your credit score. So there's other factors that take place that actually need to be in line in order for you to accomplish the highest credit score. Now, what we're doing here is we're taking the highest credit score, which is an 850, and we're taking the lowest credit score, which is a 300, and we're going to talk about those 555 points in between. This segment is going to break down those 555 points, right? So when we're talking about payment history, the 193 points. Payment history is broken up into actually 30-day increments, 30-day, 60-day, 90. So let's say hypothetically I have a payment that's due January 1st. I miss January 1st's payment, but I make February 1st's payment. That means that payment was only actually a 30-day late payment because I never actually made January 1st's payment. A 60-day late payment is, let's say I had a payment that's due January 1st. I missed January 1st's payment. I miss February 1st's payment, and then I make that payment on March 1st. When I make March 1st's payment, that's going to be considered a 60-day late. Now, theoretically, you can miss one late payment and have multiple late payments off of one late payment if you never make up that payment. So let's say, for example, I have a payment that's due January 1st. I miss January 1st's payment, and I make February, March, April, May, June, July. I make all the rest of the 11 payments for the year. For the simple fact that I never caught up January's payment, and that payment schedule would say that I was late, 30 days late for 11 times, even though I only missed one payment in a year cycle. So that's something very big to understand, especially for a lot of people who are trying to get into that home ownership category. Your lender and underwriter is most definitely going to be looking at that. The next category, next segment is going to be, I'm still on that same slide. The next category or next segment with 30% of your credit score would be debt and available credit, which is 165 points. Those 165 points are predicated based off of how much of your credit you're using. I have a lot of clients who are actually failing in this category for the simple fact that they think just because they pay their bills on time, that at the end of the day, that's going to equate to a high credit score. Now, the credit scoring system is also grading you with how much credit you're using. if you're using the credit cards, the system is reading that as if you're a high risk, and the higher the risk, the lower your score. So theoretically, you really don't want to use credit cards. So I tell people all the time, I have over $250,000 worth of credit cards, right? But I only have $2,000 worth of debt. However, I sleep a lot more comfortable knowing I have access to their money, but I sleep even more comfortable knowing that I don't have any debt attached to that money. So credit is really used for emergency purposes. A lot of times we have a misconception of credit. We're using credit like a debit card. We're using credit for our everyday purposes. We're trying to get rewards points. We're trying to get all these little credits, but at the end of the day, what we're paying in interest normally negates the credit that we're getting in the first place. So I just caution you guys. So anytime you have a credit card, the perfect ideal utilization or the usage should be 7%. So let's say theoretically I have a $1,000 credit card. For credit scoring purpose, I should not spend over $70 on that credit card. That's when I spend over $70, the credit scoring system reads that as Andre is in financial distress, that's why he needs to borrow money. Therefore, the higher the risk, the lower my credit score, all right? So the ideal utilization is 7%. A lot of times, society or the street myth is 30%. You know, keep your credit card debts at 30%. That's really just a myth. And that really comes from the lenders who are loaning us the money. A bank will never give you a credit card until you don't use it. They won't make any money off of it. So what do? They say, hey, get this credit card. Don't max it out, but use 30%. That way they're still in position to gain interest and make money off of you, all right? So the ideal utilization is 7%. The maximum is 30%. So just to put this in example, if you have a credit card at 30%, that's like you eating McDonald's every day. You're gaining nutrients with that diet, but you're also gaining fat, okay? 7%. 7% is like a juice diet or fruits, nuts, and berries diet. You're gaining nutrients at that particular diet, but you're not gaining any fat, okay? Then I have some clients who are like, well, Andre, well, I just won't use my credit cards at all. I'll pay them down to a zero balance. And that's not healthy as well. That's like not eating. Not eating will cause me to lose weight. However, I'm not gaining nutrients by not eating at all. So you still have to nibble off of food. We don't want you to indulge. The same thing with credit. We want you to nibble off your credit. We never want you to indulge in, all right? The next category is going to be length of available credit. I'm sorry, I was still on that slide. I apologize. Length of available credit is 83 points of your credit score. This is how long you've been in the credit game, okay? So you have a freshman who has a 4.0 GPA, and you have a senior who has a 4-point GPA. Who's stronger? Theoretically, the senior, okay, is stronger than the freshman. Why? Because he's shown to be able to have the contributing habits for a longer duration of time. So where, for that standpoint, he's getting credibility on the actual duration of having the correct habits for a duration of time, okay? So 83 points of your credit score is just predicated off of having the right habits for a long duration of time, all right? The next category is going to be types of credit. There's 3 different types of credit. There's installment loans, all right? Installment loans are like car loans, personal loans. An installment loan has a start date and a finish date. It's what it amortizes over time, all right? So when it amortizes, when I get a car, if it's a 5-year loan, I get a 5-year loan. It starts day 1. I make 60 payments. After 60 payments, it's actually paid off. It's considered an installment loan, has a start date and an end date. The second type of credit is revolving. Revolving lines of credit are like credit cards. They're considered revolving because they will actually outlive you. I can have a credit card and it can necessarily outlive me if I handle it correctly, right? It revolves over time. There's no start. There's a start date, but there's no end date. The end date is either when I break the relationship with them or they break the relationship with me. And then the third type is going to be an open-end line of credit or a charge card. Most of us know that as like an American Express charge card. Per se, I have an American Express charge card, but if I were to use that charge card, not a credit card, it's different than the credit card. A charge card means the balance has to be paid in 30 days in full. So I have an American Express Platinum charge card. I can charge whatever I want on that credit card. However, it has to be paid within 30 days. I can't stretch the balance out and revolve it over a monthly period, okay? And then the actual frequency of new credit. This is where a lot of people also mess up with their credit score. 55 points is predicated based off of you applying for credit in a timely fashion. Now, inquiries can be somewhat taboo because at the end of the day, half the time we're telling you you need to have positive credit, but you also have to be choosy with who you're going to actually try to acquire that credit with. It's like a guy who goes to the club. He tries to talk to 20 chicks, right? He gets to the 21st chick. He's like, you know, hey, baby, you're the one. She's like, no, I'm not the one, because if I was the one, I would have been the first one you came to. However, I'm only the one because you spoke to 20 other chicks before you got to me and they told you no. The same thing happens from a credit standpoint. If you're out there shopping for a lot of credit and then you get to a lender, they feel that you're a little bit messy from a credit standpoint. You'll, what we'll say, sleep with anybody financially, okay? So we have to be very careful with that, because those inquiries, even though they don't feel like they're damaging, can be very damaging to your credit score, all right? And we can go to the next slide if you don't mind, Fabiola. Thank you. Now, a lot of us view our credit scores on Credit Karma, all right? However, Credit Karma is giving us a totally different credit score than what Marc or any type of mortgage lender is going to look at. Credit Karma is giving us a Vantage score, okay? Totally different name brand than a FICO score. When banks and lenders are loaning you money, they look at a FICO score, not a Vantage score. So when we're talking about FICO versus Vantage, they're totally two different algorithms, right? Which they take your data, but they're two different algorithms that determine your credit score. FICO is used for mortgage lending. It's a little bit more pricey. However, it's considered to be more accurate. However, you have the Vantage credit score, which that Vantage credit score can be considered actually a less pricey credit score, but that's the reason why platforms like Credit Karma will give it to us. Now, Credit Karma is not your credit score. I'm gonna repeat that again. Credit Karma is not your credit score. Credit Karma's job is to work as an affiliate partner to refer you to credit card companies, all right? So Credit Karma made $1 billion last year. I don't think none of us paid Credit Karma $1. I've used Credit Karma for years and I've never paid them $1. However, Credit Karma makes anywhere between $15 to $25 every time you apply for a credit card, and $35 to $75 every time you're approved for a credit card. So if you've noticed your Credit Karma scores go up and down, and when that score is going up and down, what it's actually charging is consumer engagement. If a window is opening and closing, as a consumer, it puts you in position that when that window's open, now you're gonna jump through it, because at the end of the day, last week you know it was closed. So that's the reason why they make that credit score go up and down versus keeping your credit score static through time, okay? Now this last slide is the most important slide in this whole PowerPoint, right? The reason why this shows you based off of a credit profile exactly how much interest you could be paying based off of a credit score. So you have 3 individuals here. They work the same job, they have the same little badass kids, they have the same amount of money in the bank. Everything is actually the same. The only difference between these 3 individuals is the credit score. So this gentleman, this good-looking gentleman right here has an 800 credit score. I'm just playing with y'all. This lady right here has a 700 credit score, and this gentleman here has a 600 credit score. So even though they only have a difference of 1% difference in their APR, when we look at the amount that's paid over time, it's a totally big difference, right? So on a $250,000 house with a principal and interest payment of $1,123, you would pay a total of $154,000 on a $250,000 house. That means even with great credit, an 850 credit score with this scenario, you would still spend $404,000 for a $250,000 house. Don't say not me, because if you buy a house, you're gonna fall somewhere on this category, right? Hopefully it's with the 800 credit score. However, you have a mediocre credit score, 700. The difference of the payment between a good credit score and a mediocre credit score is not a lot of money, right? The difference of the payment here is $144. Very, very affordable, all right? However, when we look at the interest paid, the person with the mediocre credit still paid $52,000 more for their property than the person with good credit. And then of course you take the person over here with banged up credit versus the person with good credit. This person paid $511,000 for a $250,000 property. So this person with banged up credit actually wound up paying $107,000 more for their house than the person with good credit, all right? So theoretically, you don't want to fall in this category, because it feels very, very uncomfortable knowing that you spent $107,000 for the same exact house as your neighbor only because they had a 100-point credit score higher than you, all right? So it's gonna be very important that you do everything you need to do to get in front of your scores. Make sure you're maintaining your scores. look at some type of credit monitoring. I advise you guys to do some type of buyer consultation prior to you actually figuring out what type of house you want to buy. That way you can put yourself in position for affordability factors. And how am I on time, guys?
Just time now, so that we can
Okay.
get to the next presenter. Thank you.
Thank you, guys.
Shani, you're up next. Is Shani on?
Yes. Yes. Can you hear me? I'm sorry.
Yes, we can hear you.
Shani, you're muted.
If she needs more time, Marc, we can move on to you if she needs more time. Let's see. I don't know if she's having technical difficulties.
I think she's returning.
Okay. Shani, are you ready? We can't hear you. Okay.
Yes. Can you hear me now?
Yeah, we have 15 minutes.
Good.
You can get started, Shani.
So I'm talking more about budgeting, right? So if you're looking to say, how much am I going to save in terms of getting a down payment for your house? How you look at your money, how you're relating with your money is probably going to be the first start of that. So for those of you that are listening in, take notes. Take notes. I would prefer for you to write down what it is that I'm saying to increase your retention about what it is that I'm saying. I also have a book. It's called 10 Things Every Woman Should Keep in Her Purse. I think everyone, does anyone else have, oh, she said volume issues, so I'm sorry. It's called 10 Things Every Woman Should Keep in Her Purse. I know it's slighted towards males. When I wrote the book, it was for women. Sorry about that. But you can, if you guys, if you go in, you send me the notes that you created, I'll just send you the book for free, okay? So if you just send me your notes, you have to either go to my Instagram page or go to my Facebook page. And when you go on there and you just send me the notes that you took from my presentation, I'll just mail you out my book, okay? All right, so when it comes to budgeting, sometimes people will say to me that I don't have a budget, right? I think everybody has a budget. It may not be a functional budget, but it is definitely a budget, right? So the first thing, if you've decided, the best thing, I like when I'm working with my clients when they're saving for a specific goal. When you're saving for a specific goal, it's a lot easier to get you there versus when sometimes my clients come to me and they say they just want to save money. Well, that's a little bit different. Think about someone who, if I say to you, hey, we're going to get ready and go to this beach wedding, and everybody has to show up in a bikini. Everybody, that's just the requirement. If you're coming to the wedding, you have to wear a bikini. So there might have been people prior to getting that invite that were on a diet, but I can almost bet my bottom dollar that now that they know in 90 days, we're going to this wedding in a bikini, everybody is suddenly on the best diet in the world. HGC shots, you name it, they're on it because they have a goal and they can see themselves that. They can see themselves there. So the fact that your dollars have a desire, it means that you can definitely get to your goal a lot faster. The first thing that you would want to do is decide if you're going to fall within the range of 3.5% or if you're going to be 20% when it comes to your down payment. That will dictate your savings goal. That'll let you know how soon you're actually going to get there. Okay, so that would be number one. Deciding which down payment I'm going to do. Am I going to go 20% so I don't have to think about PMI, or am I going to go with 3.5%? Okay. All right, so the next thing is after you decide this is the number that I want to get to, you may look at your budget and you may go, oh my goodness, I don't know how am I going to get to this particular number to, I don't know if I'm going to get to this particular number based on my current income or based on my current habits. So that's when you're going to have to take a serious look at your budget to look at your income versus your expenses, your income versus your expenses, and that little space in the middle is going to be, that little tiny space in the middle is going to dictate how much you can begin to save, okay? So there's only two real ways. I say this to people all the time, but there's only really two real ways to really change your budget, right? Either decrease how much you're spending or increase your income, right? So I like to people to do both at the same time. I like to see them work on increasing their income at one point, and I also like to see them to do some decreases, right? One of the ways, it might be a little interesting right now, I've been pushing some of my clients to go ahead and do it simply because some people have been getting laid off. So some people feel a little, they feel a little antsy, like they could go in and ask for a raise. Some people just like, Shani, I'm glad to have a job. I'm not about to press these people about a raise. But you think about your seniority, you think about the contributions, you think about the timing, and see if that is a possible income increaser for you to increase your income. Because again, you looked at your budget, you looked at how much is coming in, how much is going out, and you're looking at that tiny space in the middle, and you want to know, how can I begin to fill this up and expand it, right? So you could ask for that raise if you feel in some kind of way, right? You can ask for it. I always ask, and what you can say is no. Right? So that's one way to increase your income. The second one is to look for a side hustle. So right now in this particular market, a lot of people, there's a lot of different jobs out there, right? There's a lot of different things you can do to work online. There's a lot of packaging and shipping and all kind of extra stuff. Not necessarily that could be counted into your income, but it definitely can help you create your savings, okay? So that's another thing that you can do, in just looking into a side hustle. Another consideration that you can do is freeze your retirement investment just for the period of time that you're saving for your home. So maybe the 10, 15%, the 9% that you're doing towards your savings, maybe you'll say, you know what, I'm going to hold off to that, and I'm going to put it in a special fund, right? So you may want to consider getting a special fund for your savings, because if you're anything like some of my clients, they have already set up a checking account and they've already set up a savings account, but every now and then their checking and their savings be getting confused. You know what I mean? So it would be better if you would go ahead and take that savings account that you have earmarked specifically for down payment and put that at a totally different bank, right? That you don't have access to, and you may not want to let it have transferring capabilities, because sometimes when you see something, you know what your goals are, but all of a sudden you forget that you're buying the house, right? That's also something that happens with clients. When I improve their credit scores, they almost forget that, hey, listen, I'm looking to buy a house. They think that we improve their credit so that they can buy a car or get more credit cards. I don't know how they get confused. I don't know what happened. I think once their scores start going up and then they start getting those offers in the mail, I think they forget that the goal to improve your credit was for you to get a house, right? Another tip would be, when it came to those credit cards, right? As you build up your scores or rebuild your scores, don't put anything on your credit card that does not begin with a G, right? That's how you want to stay under that 7 to 30%, okay? Don't put anything on there that doesn't start with a G. What are things that you can buy that you feel good about that start with a G? Gas and groceries, right? So if you say this don't start with a G, then this must not be for me. This is a very simple way to respect your credit cards, right? And not to drive up that debt. That was just an extra that I was thinking about. Okay, so we talked about increasing the income either through asking for a raise. We talked about increasing the income through getting a side hustle as a possibility of increasing your savings. And then we start talking about retirement funds, whether going ahead and say, you know what, I'm going to do this 10 to 15% myself, where I'm going to, instead of, giving it to the retirement fund, I'm going to go ahead and put it to the side, specifically in earmarks for savings. I'm also going to go ahead and I'm going to set up a specific account for down payment. So let's talk about some things that you can begin to cut out. The good thing that I like about being quarantined, for those of you that are quarantined for real, like me, I'm like really a quarantine person. I literally only go out of the house on Sundays. That's it. I'm like real quarantine. I just go to get my groceries and I come back home, right? So it's not hard for me to spend any money. And then when I look at a lot of my clients' accounts, I'm able to look in and I'm seeing, wow, they have the opportunity to really cut down on a lot of things just because they're a lot restricted at this time, right? So one of the restrictions that they have is you can't go to the gym, right? So that gym membership that you were once paying $60 for, now you have that in your budget. So the trick is, though, whenever it is that you're saving on something and you're getting rid of something, you're removing it outside of your budget, right? You have to make sure that you don't put it somewhere else, right? So you have to make sure remember to yourself specifically that the $60 that I once was spending on my gym membership is now going directly into my savings account. Another good thing that I did when I was paying off my mortgage completely is that me and my family did not go out to eat. We just did not go out to eat. We did not. It just didn't happen. We didn't go out to eat at all. It just wasn't a thought. It wasn't figured in. We just did it. So if you decided that you're only going to go out, maybe you're not as aggressive as I am. You might not have all of those discipline, but you may decide to yourself, hey, what I'm specifically going to do. I think the people in the other room is a little excited. Hold on a second, I'm sorry. Okay, they think they caught it. All right, so Fabiola, make sure you can tell me if you can hear the outside noise. I closed the door and I set it out so that you might have to message me if you keep hearing. Okay, what I was going to, just for my own conscience, I was on a point, it was a really good point. Put it in a specific, if you're gonna take those savings, you're gonna put it in a specific so that you don't think just because you got the $60 that now the $60 is something else. Then I was talking about just deciding not to go out to eat, right? Maybe you're not a renegade like me where you're not gonna say, okay, I'm not gonna go out to eat while I'm saving for my house. Maybe you're not as aggressive as I am, but maybe you'll just decide that you're just only gonna go out to eat for special occasions, right? Only for special occasions. And that could save you an additional $250 a month, right? Just thinking about that. Another cool thing that I've been looking at is things that I can do for myself, right? There's things that I can do for myself. I used to be so codependent on society. There were like so many things that like, I just felt like I needed, like, you know, like so many things, like I would never do my own nails, I never do my own hair, I would never do my own feet. I was just like so many services that I was just so codependent on just for the luxury of it. So you are saving on those things based on the quarantine, or if now you're like, you know what, it would be kind of cool to just keep this, because if you get your nails done twice a month, that's $120, right? The ad fee, oh my goodness, now you're at $240. Waxing, oh my gosh, now I'm at $300. So you just kind of got to look around a little bit. Also, if you have children during this period of time, like cutting the cable is actually really good. I know you're thinking, Shani, cut the cable right now, like when we're in the quarantine and there's nothing else to do, like kids are going to drive you crazy and we're never going to actually make it to the house, right? I get it. But you could definitely look for some more sophisticated ways. I don't have cable, but some people are not as aggressive and, you know, renegade-ish as I am. But you can look into some other ways to cut down on your cable. I think I might have covered my entire list that I wanted to share with you. I'm more so waiting for the questions because I get really weirded out when I'm just talking to a screen. I prefer interaction. But those were just some base level ways that you can begin to save for your down payments. Increasing income, looking at how you waste, actually looking at your budget can really create some different habits for you. Oftentimes when I sit with my clients, one of the things that I like to do with them is just to have them to look specifically at how much they're eating out. And I will, even though I have I have sophisticated applications that you can use to do this, I like to have them to go through the actual experience of looking at their bank statements and simply just writing down every time they went out to eat. I mean, every time, because sometimes when you see it on the spreadsheet and you get, oh my goodness, you spent 40% of your income on eating out. Oh, you spent 30% of your income on eating out. Yeah, you see this, you see the chart, and yeah, it's a little overwhelming. But when you go to that activity of actually writing down Dunkin' Donuts, Arby's, Chick-fil-A, pizza, Uber Eats. It begins to register in your mind that lets you know what, it's not so much that you're not making any money, it's simply because you're eating it all. So those are just some very simple things that you can look at as it relates to your daily habits that can help you get to saving your down payment a little bit faster. I'm waiting for the questions because I like talking with as opposed to talking to.
Well, since we're short on time, we'll finish the presentation and then we can get to questions at the end, and people can continue to leave them on the chat.
Got it.
So Marc, is all yours, and I'll have your presentation up, Marc.
Perfect.
Perfect. Welcome, everybody. Can you hear me? Hello?
Yes, we
can hear you.
Yes.
Fantastic. Great. So let me just kind of go ahead and introduce myself as well. I'm Marc Williams with Paramount Residential Mortgage Group. I am a mortgage lender with Paramount Residential Mortgage Group, and as my slide comes up. Listen, folks, I'm glad to be here and glad to share a lot of information as it relates to getting qualified as a first-time home buyer and accessing down payment and closing cost assistance programs, really to help you buy your first home. So I'm just going to throw the question out there: why do you want to become a homeowner? Okay, so think about that for a minute. Throw some information in the chat room, and we'll just kind of come back to it at one point or time. So one of the next slides is, should you be buying a home amid the COVID-19, right? Not COVID, but COVID-19. And I would say that think about this for a minute in the sense of there are individuals who are currently in a renting situation, and it's okay to be in a renting situation, but those are also individuals that are looking to buy their home and being able to purchase their home in a market that might seem very stressful. So what I would tell you this is there may very well always be a crisis. In 2007, 2008, we had a crisis as well, and folks were still buying a property. So what I would tell you is look at your finances. You talked to Shani, and also what Andre was mentioning as well. Digest that information. It may be a great time for you to go ahead and still buy. But I will tell you this, there is some benefits when you're looking at a individual who's renting versus a person that might be actually a homeowner. One, some individuals don't like to be told what their landlord has set for rules for them, right? I know for myself, when I was renting, I really wanted to turn up the music and dance and be loud as I wanted to be, and not have to worry about the neighbor knocking on the door, okay? And not to say that you wouldn't have that in a home ownership situation, but if you're living wall to wall with someone, you might not have that comfort level. So there's a bunch of other benefits as well. I right now am in the process of growing a vegetable garden in my backyard, right? I might not have that in a renting situation. So what I would tell you is there are some benefits, and the most benefit with purchasing a home, even in the mid of a crisis, is really equity. And equity is the difference between what the market value of a property is compared to the balance owed on that property, that loan, okay? So for just a rough example, if I knew that the value of my property were to be sold at $150,000 and I owed $100,000, that's $50,000 worth of equity that I could take out of that property and use to open up a small business, send my child through school if I needed to, or take a long, great vacation if I wanted to. So if you get nothing else out of what we're sharing with you today, please remember there's a wonderful thing when you purchase a home, that's equity in that particular property. And also, for those of you who have children, generational wealth is something that's really, truly important to be able to say that you're leaving something behind for your kids and for your family if you should pass, unfortunately, okay? So let's move on to the next slide. I want you to know there's $100,000 in Miami-Dade County and about up to $60,000 in Broward County. Now, these monies are coming from our state, are coming from our federal government to be able to increase homeownership within a particular city or in a particular county. Some of the cities have their own individual first-time homebuyer programs assistance, and some of them have assistance that's through the overall county. So I'll talk a little bit about that and the requirements, but there is that money out there. And if you're working with a lender or you're talking to someone that just doesn't know, please give me a call. I'm willing to definitely share that information with you and see how you can possibly qualify. These programs do work. Unfortunately, there's some individuals out there that don't believe in the programs because the programs sometimes take long. Well, I'm here to tell you that we're working with the program for over 20 years, and these programs are successful and they work very well. Hence, I see your hand, Latanda.
We can move to the next slide for time's sake, please.
Fair enough, thank you. So just real quick, some of the things that we really want to keep in mind is, looking at your household income for the programs, family size, geographical area, and making sure that you're a first-time home buyer and have not purchased a home within the last 3 years. And some programs are based on credit. Andre talked a little about credit, and we really want to make sure that you have a credit score of a 620 or higher. We can move forward. So as I mentioned, this is just a quick slide to talk about unincorporated versus incorporated. What I want you to realize is there are funds both in unincorporated cities and in incorporated cities. And we can sometimes combine those funds to be able to help you as a first-time home buyer increase the amount of money that you may need as well. Okay, moving on.
No, 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 no.
Okay.
I'm sorry. I'm sorry.
No worries. Let's go to the next slide.
Oh, and just for clarity, it's only because we have a down payment assistance presentation next webinar.
Excellent. So reasons why people don't necessarily buy. They don't know how to start. They think it's not the right time. My credit score, they don't like the real estate market, and they don't have enough money saved. Well, the information that we're going to share with you really is going to dispel a lot of those myths or reasons why you might want to consider not buying in a particular market. But definitely, it's something that you want to look forward to doing. Move forward. So some of the things that you should know, the prices of homes and the median sales price of home has definitely increased since 2019 when it was at 270,000. It's actually at 285 to 295,000 right now in the Miami-Dade County market. You definitely want to get approved and shop before go shopping for your property, and also knowing what your budget is. Shani talked a lot about that, knowing exactly how much you have saved, but also how much you really can afford in a monthly mortgage payment. And don't necessarily be always concerned about the price of the home. The main thing is to get in the game and actually purchase something. Move forward. So I'm just giving you a quick example here. This is an individual who's purchasing a $285,000 property, and the estimated amount with everything included, their principal, interest, taxes, and insurance, is about $2,354, and this is at a 4.875 interest rate. However, that payment would be a lot lower in this current market when we can offer 3.25 on a fixed interest rate right now as well, depending, of course, upon your score and how much money you're putting down. We can move forward. So these are just 5 steps that I really want you just to remember and know. Know what your requirements are, be prepared with all your documents, and definitely know who your team is. And what I mean by your team is your real estate agent, your lender, your loan officer, searching for the right home, and knowing exactly your closing agent, your title company that's going to help put together the transaction for you to be able to close your transaction on time. So those are the members of your team that I really also want you to make sure that you're concerned with. And then I'll just leave it at this. Knowing the requirements is going to be important. I'll leave it at step 1. Knowing what the minimum credit score is, knowing that you should have anywhere between $5,000 to $10,000 saved, and the minimum 2-year job history, okay? And then motivate yourself and be diligent. Surround yourself with individuals who are on your team, but also surround yourself with individuals who are gonna motivate you. The last thing I wanna do is hear from someone who hasn't bought a home and never has any intention of buying a home that's going to tell me about buying a home, right? So just keeping that in mind, whether it's family, friends, coworkers, or whoever it is, making sure that you are surrounding yourself with people that are going to be your cheerleader and motivate you through the process. And I'll leave it at that slide. Thank you, and I'm looking forward to working with everyone.
So Marc, there's a question for you. So there is a woman who has a question about self-employment. So she files both business and personal taxes, but that could be challenging with being qualified for a mortgage. So can you speak to that?
Great question. So for a self-employed individual, we as a lender are going to be looking at the last 2 years of your self-employment, okay? And of course, your current profit and loss statement year to date. And hopefully there's some progression in your income increasing as a self-employed individual. So we are going to be looking at the taxes for the business to see how that business is doing, your profit, your loss, and also how much are you actually paying yourself as an owner, okay? So if you're not, I urge you to really be looking at how much you're paying yourself, and is that enough to hopefully get you qualified, because that is the income that we're going to be taking into consideration. We are going to be looking at how profitable your business is, but we are most likely going to be more looking at how much you're actually paying yourself as an owner, as a president of that business. Hopefully I answered the question.
Can you also maybe go another minute extra regarding that part? Because every time MDEAT does a small business workshop, that's always the one thing that comes up. A lot of small businesses, proprietors and such, don't necessarily pay themselves an income.
Right. So I will say this. A lot of first business owners, if you will, what they end up doing is thinking that they can do everything themselves. And someone told me not too long ago that try not to do everything yourself, right? Pay the right individuals to provide you the expertise and the service that you need in order to help grow that business. So I would say this: if you don't have an accountant, get yourself an accountant. If you don't have a tax preparer that understands your business and the benefits that your business brings, get yourself a tax preparer that's going to look at your business and tell you exactly where you may need to cut expenses, how you can possibly increase your income overall. So be thinking about that and hire the right professionals to be able to get you where you want to go. And hopefully that answers it as well.
Okay, so Mark, we have another question. Well, and this could possibly be for some of the other presenters as well.
Okay.
So Andre, someone asked, what's a good site to use to monitor your credit score? Since you did mention that Credit Karma is not the most reliable, or the one that a lender like Mark would use.
Well, unfortunately, if you want to get access, and only the score that only counts is the score that the lender who's giving you the money is pulling. All right, that's the only score that counts. So I say, if anything, is you want to kind of get a glimpse of your FICO score before you're getting into the homeowner process. To do that, you can go to myfico.com. However, that score is a little pricey. It can run you roughly about $60 for that credit score, $40 to $60 depending on when you're trying to acquire it. And then they only provide you that credit score quarterly, only 4 times a year. However, it will give you the precise score or one of the versions of credit scores that Marc would be using for their underwriting process.
Okay, so Marc, for you, do you as a lender rely purely on the Experian or credit score or Equifax credit score? And then also certain credit cards offer you a free credit score, right? So is that a good baseline?
I would say that we're definitely using the FICO score and your middle score. So as on there's look at the one in the very middle. A high, you have a low, and the one in the middle score is what we're going to be looking at. Now, we as a lender, we can approve loans at a scores of 580 or higher, but ideally in this particular market, with guidelines changing as it relates to COVID-19, I would say strive to have a score of a 620 or higher. Okay, and that's what we're going to be looking at. That's one factor. We're also going to be looking at how much money are you currently putting down? The type of property that you're looking at. Is it a condo? Is it a single family home? Is it a duplex that you're buying? So all those different types of properties and those different pieces to the puzzle are exactly what we're going to be looking at to determine if you're going to be a good borrower and qualified for that home that you're looking to purchase. But credit score, we are looking at the FICO score and the middle score.
Another question is about student loan debt and its impact to mortgage qualification. So the balance in keeping that versus anything else, and how that would weigh against your debt to income ratio for a mortgage loan.
Right. So here goes back to score, right? So student loans, depending on the type of loan product, an FHA product, Federal Housing Administration loan product, or a conventional loan product through Fannie Mae or Freddie Mac. These are secondary lenders that we sell our loans to. I would say they, of course, are looking at student loans differently on a conventional versus an FHA. With an FHA loan, we have to count 1% of the balances or whichever is higher on the credit report. So on a conventional loan, typically an individual receives from their student loan provider a letter stating that that student loan is in forbearance, or it's at a very low payment, or they receive what they call an income-based repayment plan or an income-driven repayment plan. And that, in most cases, is a lot lower than counting the 1% on an FHA type of loan product, right? So I would say the better your score is, right, that will help with your student loans and deciding whether or not we go the conventional route or the FHA route. And typically the conventional route with those types of student loan letters will reduce your debt and help with those ratios that we're talking about.
Okay, so to add to that, I remember when I was purchasing my home for student loans, they do it based off of your actual payment due, or even credit card. So whatever the current amount due. So if you have it in forbearance, or if you have a certain payment plan that gives you a lower amount, that would be how they determine that number in comparison to your entire debt to income ratio. Is that still applicable?
Yeah, so let me kind of put it in perspective as well. So for example, you may receive a letter from, let's say, Navient, I think. And Navient says your student loan payment is $150 for the next 9 months, 12 months, or what have you. And it might be zero. We're going to use what is on the letter, okay? And thereby reducing your ratios, because the ratios, when we're talking about their debt to income ratio, that's going to really take into consideration your gross monthly income versus the amount of debt that you have. So if you have a very high debt, that's going to decrease the amount of money that you have as discretionary income that can increase your affordability and also increase your debt ratio. So we want to keep that debt to income ratio as low as possible. So that's how the debt comes into consideration when we as lenders look at your student loans and any other debts that you may have. I will tell you this, that the lower your debt is, the more affordability you're going to have in the long run, and the less risk is for a lender when reviewing your overall profile. So just keeping it in mind, it might not just be your student loan, but it might be other debt. And also reach out to your student loan provider and say, hey, listen, this is what I have, and it's unaffordable for me right now. And you'll be surprised, especially in the particular market that we're in, they're willing to lower those payments for a period of time. And that period of time might be time for you to purchase your property.
Good point. And if you extend your forbearance or deferment for at least 12 months, it won't count against your debt to income, right? You're looking at short-term debt, right? Or debt that's current right now. Correct,
exactly. We're looking at that payment, not the future payment, even after you. Once we're trying to get you to closing, right? So getting you to closing is that debt as much as possible. What you do after that, okay, is your business. But I will tell you, and I know Shani will talk about this, you still definitely want to have a budget in mind, okay? But yeah, definitely. We're trying to lower that debt during that time period, and hopefully after you change your lifestyle to the point where you're also looking at your finances and continually lowering your debt throughout that loan.
Shani wanted to add something to that as well.
To add something to it, for those of you who just looking to shape up your budget over the long haul, if you do find some of those windfalls after you write down your budget, income versus expenses, and you find that you have some overages, you may want to consider paying your student loans right now if you're not paying them, even though right now you don't have to make any payments until the 30th. But the good thing about it, if you're paying $50, $60, $100, whatever that number is, because there's no interest on those loans right now, you're actually hitting the principal, right? You're hitting straight to the principal because there's no interest up until September the 30th. So that's something that you want to think about in terms of just getting that debt down before the house, in the house, after the closing.
Excuse my interruption. I'd like to add some real-time, real-life information with regards to student loans and student loan debt. You really need to speak with the lender and loan officer that you end up using with regards to your student loan debt. Underwriting guidelines in that regard have changed. I've seen lenders that, regardless of deferment or payment or possible payment out of deferment, are using a flat 1% of the balance. And for people with large student loan debts, that has actually taken them out of qualification ranges and adversely affecting anything from their interest rates to their cost involved. So you need to be prepared to provide documentation with regards to exactly what is the standing and possible future debt of your student loans, as well as having a discussion with your lender, or make sure that your loan officer has a discussion before your file is submitted to underwriting, so that can be properly addressed at that time. Because if it's after the fact, it will at least slow down, if not possibly adversely affect your qualification for a home. Sorry to interrupt. Thank you.
No problem. I know this is LaTonda again. I'm going to start my video. I know that Fabiola has another event right after this. So I'm going to just ask one for our presenters. If you could please post your contact information in the chat section so that all of the attendees can get your information if needed. For anyone who's on the webinar, if you have any additional questions, please post them now in the chat so that we can get them answered, hopefully, before our time expires today. I also want to remind everyone that we will have, continue to have different webinars in our next one. So I apologize. I did not realize my phone, my computer was not on mute, but I'm like, no. But we're going to cover down payment assistance programs and things of that nature at the next one. So I know our time is limited, so I want to ensure that Marc had enough time to cover his information today. I want to say once again, thank you to Marc, to Andre, to Shani. That was Eric Johnson, our HAP administrator here at MDEAT, who came in to give additional details about the student loan and how that impacts your credit worthiness and ability to obtain a mortgage. Please remember to follow us on your social media sites. MDEAT Info is our handle, and our contact information, I'm not sure if it's anywhere posted, but I'm going to put it in the chat section as well. Just a few reminders. Please remember that this is purchasing a home. It is not a sprint. It's a marathon. So it's not anything that's just real fast. Be patient with yourself. Make sure that you, like Marc stated, assemble a great team. You can always contact us. Go to our website. There's a plethora of information there as well. Remember that home ownership, a lot of times for Black communities, is the first step to creating wealth. So home ownership is an awesome thing. We here at MD, we're starting our home ownership challenge. 50 new Black homeowners, hopefully by the end of the year. So we're going to do what we can to educate and provide information. Please reach out to either Marc, Andre, and Shani as it relates to the topics. If you have not completed the census, please do so. The census impacts our communities in such a great way. We wonder why we don't have grocery stores and different amenities in our neighborhoods. It's because they think no one is there. We have not submitted our information. So please, if you have it, please fill it out. You can go on your phone, on the computer, and it takes a few minutes. So please make sure you do that. I want to say thank you again. Please make sure you follow us on the social media site so you can get the dates for the next webinars. Are there any additional questions?
Yeah, I wanted to make a quick comment.
Oh, Fabiola, you're still there. Okay.
Yeah, just for like 1 minute. So for
Okay.
each of the presenters for 60 seconds, can you quickly let everyone know what specifically, what type of services you have to offer to attendees? Marc, you can go. Start.
Well, services are definitely down payment and all the down payment assistance programs in Miami-Dade County and Broward County. We also are offering lender credits to be able to help a first-time home buyer be able to bridge that gap for what they have saved and what they may need at the closing. And definitely we're working with agencies such as Credit 360 to be able to help individuals with their credit as well and putting you on the right path. So those are some of the additional services that we definitely offer as well.
Shani. Oh, go ahead, Andre.
Andre, Credit 360, we provide credit repairing services, not only just repairing, but also structuring and building. And also just for you guys who are business owners, one of the aspects you might want to look at is working on your business credit as well. That can be also ways to take some of that pressure off of your personal utilization. That way you can put that debt on your business credit, therefore it no longer be showing on your personal credit. It can help with the home buying process and get that debt ratio down and lower.
Shani.
Here we go. All right, so I'm Shani at Person Empowerment. I essentially help my clients do two things. One, I help them build functional budgets so that they can obviously save for a down payment. And sometimes my clients just want to work with me specifically just so they can create a better relationship with their money altogether. And of course, I help my clients with improving their credit scores. Thank you.
Okay, so I'm not sure if Fabiola is still here, so I'm going to say thank you again. Everyone, the presenter's contact information is in the chat, but as Fabiola stated, that the recording will be sent out to everyone who's on this chat, who's on the webinar, and that will include the presenter's contact information as well as the information for Miami-Dade Economic Advocacy Trust. Don't forget what Shani said. If you send her your notes, then she will send you out her book. She'll gift you your book. So, and make sure you share the information, please. Transference of knowledge is important. So please make sure you share this information. I want to say once again, thank you to Marc, to Andre, to Shani, and to Fabiola. And I hope to see everyone at our next webinar, and we will post that date and information shortly. Have a great day. Thank you.